Now we're going to go through refined products. What are we seeing? What is our expectation, not only into the end of the year, but then as we look into January of next year? And we continue to see these slowdowns that we've been talking about. Now, before we get into this specific chart, we just want to highlight that we have seen some crack spreads rally, but it's important to understand that we normally get an increase in crack spreads over this time period. So even though we've seen an increase, it's still well below the 5-year average when we look at the 3-2-1, which is a calculated one. And gasoline continues to find a bid for some reason. But again, the issue is going to be, where are we sitting as we head into the end of the year? And then how does that put us into the beginning of next year as we continue to see cases continue to rise? Now, as we had been highlighting, there was going to be some timing delay. So we did get an increase in gasoline demand, or implied demand, which we were talking about. We did start to get some other implied demand increases, but what right now the current is about 13.4 million barrels a day versus the 12.4 that we saw last week. So about an increase of about 1 million barrels a day in demand. But when we think about where we've been normally, we've been between 13.2 to about 13.5. And that's why, as we keep talking about, we were going to have lower lows, lower highs, and that's what we're seeing now as we go into what we expect to be another slow week this week, and then next week, especially as people look to do less ahead of the holiday season, which is just going to continue to put pressure on refined product demand, as we do have more imports coming from Europe. They are slowing, but they still are on the water and will get here. As we talked, there's about 33 cargoes still heading this way, and that's going to keep some of these imports fairly firm into the end of the year. Now, when we look at distillate stock builds, you can see that we had a build of about 170,000 barrels, and it was really driven based on the increase in imports. And as we said last week, we didn't see a huge spike, but we figured that there was going to be, a fairly sizable continuation, and we got it again. 156,000 barrels came into Pad 1, or the East Coast, which is going to keep things, which is really kind of what drove some of the gains that we saw, as we did see a reduction in yield, or I should say production at the refining level. So we had refiners that walked back about 80 basis points, which actually the shift was create more gasoline, less distillate, and distillate was fairly flat. And you can kind of see why we're coming to a point where weather is not really cooperating, even though it's very cold out today, and it's going to be cold for the next few days. We're starting to see a little bit less on a heating demand level, and when we look across all of the U.S., and you can see that we've essentially flatlined on the builds after getting some 2 weeks of very large builds over the the builds will continue. We just think it'll be at a slightly slower pace. And that's when we look at implied demand. Implied demand, as we were saying, we thought it was going to get back to the 5-year average. It's just below the 5-year average. We think it's going to have another small increase, but it won't get to the same kind of peak that we've seen previously, just because we don't have the same demand levels. And the reason why we don't have the same demand levels is when we turn to, where are we consuming the most gas, the most diesel on the road. So road demand. So we still see an increase overall year over year, averaging between 8 and 11% of diesel demand on the road. But here you can see, as we've been saying, 95 to 105 is our comfort range. We're at 99.5. Again, nothing to say that that's going to continue to adjust. We do have specialized trucking rates increasing. Refrigerated rates have started to come down again as we get through Thanksgiving, refilling ahead of that. Now those rates are starting to come back down. As you can see, that there was a big spike essentially through all of November. That's now done. That's now done and over. Truck availability is fairly flat. Load availability is coming down a little bit. So we will see a little bit of a reduction, but again, nothing too crazy, because there's going to be that one final push, and then we'll get a big drop into the holiday season, which should maintain through most of the end of the year as people look to kind of slow down. Now, when we look at rail traffic, total car loads were down 2.2%. And even though we did get a big increase in grains, which I can't say it enough, it's going to remain strong year over year. We did get some bigger drops in chems. So chems is still up year over year, but it's down from the 13% that we saw last week. That's going to start to normalize because we're now. The problem with the chem side is when we look downstream, the downstream economics don't look as good. So we are seeing some slowdown in some of the purchasing. We're starting to see some of the chem slow, especially as we go into the end of the year. That's going to put some headwinds into the chemical side. Grains will stay strong, whether it's something that'll pare back a little bit, but there's going to be this final push into the end of the year to kind of clear some of these grains. The bigger issue that we continue to see is obviously metallics, motor, non-metallic, and then the petroleum and petroleum products. Petroleum and petroleum products is going to continue to be slow. We have seen an increase in carloads coming from the Bakken and going not only into the West, but also to the East Coast. That has started to slow a little bit. And again, there's just really no real demand for gasoline and diesel at this point. So that's going to continue to be a headwind as we go into the end of the year. And then as we start, Q1 of next year. Intermodal had a nice, another little pop, went from 10.9% year over year. Now it's up 11.1%. Again, these are some positives that we're seeing. Total traffic was up 4.9%. Year to date, we're still down. But again, intermodal is something that will continue over the next couple of days, the next week. It's just, it won't be at the same level in terms of being in double digit. This will start to pull back a little bit, and especially as we see some of the port congestion clearing in LA and California, as some of those TEUs kind of finally get onshored and then get put onto either trucks and or onto a rail and moved into the rest of the market. So when we look at gasoline, this is one that we're going to continue to see some problems, especially as we have, let's just start with the build. So we had a build of about 1 million barrels. 660,000 was in Pad 1 or the East Coast, and it was pretty much a steady build across the board. We have obviously a blizzard. The blizzard's going to just reduce demand overall, and so not only do we have less demand from weather, but we're also seeing less and less demand in terms of just moving around as people look to try to lock down ahead of Christmas. The question is going to be, what does Christmas look like? We're starting to see that people are already adjusting their plans. About 39 to 40% are looking to do less. And by doing less, that's going to essentially just limit the just inherent demand as we go into the season. Imports still remain elevated versus the year over year and the 5-year average. They are down after a relative spike. So they're down about 201,000 barrels, but as we've been talking about, there's still a lot that is still incoming. So for the next, let's call it 10 to 20 days, we will see a steady flow coming from Europe into the U.S. The ARB has closed a bit, so the next wave will start to slow down, specifically in January. But again, we're just not seeing the same type of demand that we normally see. And January is going to be slow, in our opinion. And then when in the econ show, we're going to go more into vaccines moving around, where are they going to move around, and who's going to get it. And that'll be, that's something for the econ show. But when we look at storage, you can see seasonally adjusted all-time highs. The pace of increases slowed a little bit, but that's going to pick back up just given what we're seeing so far this week and into next week. So total gasoline demand, again, lower highs is going to be kind of the new normal. We normally get an increase ahead of the Christmas, as you can see just from not only just the 5-year average, but the bottom of that cloud chart. So again, kind of get that spike, and we think that we're going to drop back off as we head into the end of this week, and especially through the beginning of next week as people look to just do less. Which is, COVID is going to be an interesting time to kind of understand when do people feel comfortable moving about, and that's one where we continue to see these pressures. As we new things are coming across, where crude shipments from the U.S. Gulf to Asia in the first half of December are kind of on par with November rates. Again, still fairly slow. It's just there's going to be a lot of uncertainty And I think people are so burnt out that there's going to be, after a very stressful 2020, people are just going to want to do less. And that's going to, again, kind of put weight on us through the end of December and especially into the first half of January. Just looking at what's happening in the U.S. overall, you can see that we're kind of back to some of this normalcy. We haven't gotten back to where we were pre-Thanksgiving. And again, it's just as people look to do and try to protect themselves a bit more ahead of seeing some family, which is going to continue. Apple Mobility is up a little bit. When we factor in Apple Mobility and then we roll in, walking and other, it's come down a little bit. This is just looking at mobility trends as an aggregate, but when we break it out, we're seeing the trend move lower. Germany is the one that we're watching the closest because we're seeing the biggest reduction in terms of those levels. Italy, as we said, was just going to kind of go sideways. The UK is starting to slow down again. US is starting to slow down again. And this is something that is just showing that we're going to continue to see some of those issues as we progress. Now, to spending a minute on this chart, you can see the U.S. has seen some pressure. Obviously, we had Thanksgiving, which was the big drop down, but we're hanging in the high 30s into the 40s. And that's why we think that things are going to continue to get a little bit worse as we progress through the remainder of the year. And again, it's not everywhere. Like Japan saw a little bit of increase. Now they're slowing down a bit. Germany is starting to slow a bit. China is kind of flattish as we go through. But when we look at Italy, there's been a big drop down. When we look at other areas within Europe, we're starting to see a little bit of kind of this mixture of the tale of two cities as we keep talking about. So Italy traffic was down 36% year over year versus 38% the previous week. Spain was down 34% versus 31%. France at 33% versus 36%. Again, these are things that we're starting to see where UK was 17% below previous week compared to 25% the week before. And that's where we're starting to see some of those increases because net, we've seen a little bit of an increase on the aggregate of Europe. The problem is Germany's talking about going to another lockdown, which is starting up. UK, something similar, going into a different phase, which is just going to slow total demand. So for the four countries combined, average traffic was down about 30% compared to 33% the previous point. And now that we covered that, let's dig a little bit more into the U.S. So according to Gas Buddy, gasoline demand for the period Sunday to Saturday fell 2.2%. After rising 3.8% the previous week. Again, that was that timing delay that we keep talking about. So we did get another fall. That's going to show up in gasoline demand numbers. So far, Sunday was again down 80 basis points in Sunday. We did get a little bit of an increase in Monday and Tuesday. That is something that we think is going to slow down. Those are people doing as much as they can ahead of the storm, specifically in the Northeast. Those are things that are going to kind of normalize over the coming the rest of this week because so far the first 3 days we're up 2.7%. That we think goes down. And then obviously Descartes, another one. Descartes is the one that we look at. Last week they had demand up 1.6%. So you can see we're still going to get some of this normalization lower because they did have a decline last week. These are some of those different points because there's a lot of data. There's a lot of things just kind of highlighting how that gasoline demand just really isn't going to be supported as we head into year end. And this is when we look at global road usage. So this is taking the global aggregate. We're at about down 25%. And it's because when we look at this and say, things are slowing in parts of Asia. Things are getting steady in Europe and then getting worse in the U.S., which is just going to kind of keep us range bound and most likely move us closer to a down 30%. And this is why we keep talking about that is because Asia, you can see it's flattening out. But the Americas is the one that had the nice bounce. It's just based on the fact that the U.S. is the biggest consumer, the biggest driver. That's one that we think is going to see some of that pullback. Again, not down to these lows that we saw during Thanksgiving, but it's going to trend back below that, down 40%, driven by what are we seeing in COVID. Here you can see daily cases, current hospitalizations. These are things that are maintaining some of this reservation, even as we're starting to get some of the vaccines moving, starting to see some of that this pull through the system, this is going to give people pause and change that consumer behavior. A lot of people have already wrapped up their Christmas shopping. They're trying to then wrap, now that you've finished your shopping, quarantine, get tested, try to prepare yourself and try to minimize spread if you do go to see your nuclear family. And that's why when we look at net changes overall, you can see U.S., India still remains elevated, and this is, some of the numbers have a lot of noise in them, which is why we have to kind of separate out where is the noise. India is seeing some stabilization in new cases. Europe, again, same thing. You're seeing Europe, Middle East, Africa. We're not seeing the same type of declines we'd hope to see. South Korea, we're starting to see those increases as we talk about a pressure in South Korean demand. Again, India seeing some stabilization and not seeing the same type of declines that they saw after the festival season. That's concerning. And then obviously South Korea, which is going to weigh on some of that Asian demand that we're going to talk about in segment 3. And then this is looking at the frequency data points. We're starting to see lockdown indexes increase, which you don't really need just because, again, people are already concerned. People are already seeing some pressure. So that's going to keep people, give people pause as you see new COVID deaths, new COVID cases. And then when we look at, okay, well, what's happening in the rest of the economy? Unemployment's getting worse. Some of these other things continue to get worse, which is just putting more and more pressure in terms of what is the health of the economy, which we'll hear about as the Fed is supposed to speak later today. And what happens when things get normalized? And this is where, as we go through in our OPEC show, some of the issues that we're seeing with this expectation of just everyone kind of snapping back and going to work and getting back into the office. Well, these are the type of people that have moved out of urban into the suburban. You've had that first mover action. Worked from home before coronavirus, 20%. Currently are working from home, 71%. Would want to work from home after coronavirus ends. That's a 34%, between 20% to 54%. And now, will all of it be allowed? No, it won't. Some people will say you have to come back in. It's just there's going to be a natural push to work from home more, have a blended schedule, which is going to minimize some of this gasoline demand, some of these demand into, what are people just going to do less? Are they going to stay home? Or are they, if you're home, are you really going to go drive to the deli, or are you going to make lunch in your house? And the reason why this is important, because us in the Northeast were jaded by the fact that we get to take, or at least before this, we had a lot of mass transit. When you look at other areas of the country, and this is going into even Vermont, New Hampshire, so when I say the Northeast, I mean like Boston, New York, Philly, Maryland area. There's a DC area. There's a lot of mass transit. But when you look at New Hampshire, Vermont, Ohio, Illinois, the other parts of the Midwest, Texas, there's a lot of driving that, when you're going to work. So how much of that work travel goes away because I have the ability now to work from home 2 days a week or 3 days a week in the blended schedule? Again, this is coming back to, and yes, I know that SUV sales are up. More people have moved from the urban to the suburban, but a lot of these individuals that are moving from an urban setting are used to a certain amount of convenience. One of the jokes was, I was talking to a friend. He ordered a shovel on Amazon, and it wasn't going to come in time of the blizzard. And I was like, well, why don't you just go get it at the store? He's like, oh, they have them? It's like, well, yeah, they of course they do. But again, there's a certain amount of convenience that these individuals are used to. And if he ordered a day early, or if we weren't in the middle of the holiday rush, maybe the shovel would come on time. And you're just going to, it's a long way of saying you're going to see people ordering and utilizing Amazon Prime, and you're taking the urban person, putting them into suburban, but you're not changing the way they're going to do business, which is rely on DoorDash, rely on Uber Eats, rely on Uber in general, rely on Amazon Prime. Those things are so that's why we have to. I think there's an expectation of a big increase in demand that just won't really be materialized, and we're going to have to start to see what does January, February, and specifically March really look like. as we have more vaccines disseminated, as we have a bit more comfort as we come out of winter, are we going to see this big pickup in gasoline demand? So jet fuel, small decline of 5,000 barrels. As we said, we thought we were going to see a drop. This is going to continue as we see drops, we should see another decline in demand, but then we'll see a pickup as we head into next week as people now start to increase their flights for the holiday season. Here you can see TSA passengers as we're now back to 550,000 people a day. Again, 550, 850 is kind of where we see this going forward. Not much changing. Global flight departures, we had a drop because of China. The U.S. is going to stay fairly flat. We will see some increases going into next week, but more people fly for Thanksgiving than they do for Christmas. So there will be a rush. Don't get me wrong. It won't look like Thanksgiving, and it just won't look like last year because of obvious reasons. So again, these are things that we're going to have to look at, which is going to put pressure on jet fuel demand as we go into the end of the year. And just given where businesses sit and what they're trying to do with CapEx, we're not going to see a big run up in Q1 either. Open table, we get a big drop. Now we're down. You can see that the increases are getting pretty drastic. Germany's locking back down. They're at least shutting down restaurants. London, same thing. So you're starting to see some of those declines, which is being realized in the global. You can see that we're starting to get closer to, as we've been saying, this 55 to 65 level on the global side, which is going to only increase as things get a bit worse. Australia, same thing. There's 0 cases, 0 spread, 0 everything. Germany maintains that lockdown. So when I keep talking about Germany, it's are they going to extend it? Because we keep hearing about how they're going to extend that lockdown to try to help that curve along, which is going to be a problem. UK is locking down again, or I should say London is shutting down again, which is going to put pressure on open table. US, weather and just going to Christmas and just trying to do less and minimize exposure is going to limit total flow. And now the slow return remains. This is looking at office occupancy into major U.S. areas. We're just not seeing people go back to the office, and we're going to see people do even less as, again, trying to minimize exposure, which is just going to put pressure on some of these tax revenues because, as we're going to talk about in the econ show, people leaving the urban area, what does that mean in terms of the suburban? And again, taxes are going to be the biggest issue, especially as we go forward, as that demand just isn't going to be there. Real estate's going to be under pressure, which again, we're going to talk about in the econ show as well. But again, COVID is going to be interesting, and how quickly can we get these vaccines out, which is going to be part 1 of the econ show. So please stay tuned for that. We have the segment 3 coming out, looking at global market, and then we have obviously our OPEC show that's going to go a little bit deeper in terms of their most recent report. So stay tuned for that.